Hi, I'm Zig Hamner with Big Block Real Estate.
Hi, James Carmody, Vice President with Synergy One Lending.
The title of today's video is Pre-qualifying for a Real Estate Mortgage. Almost every time a realtor meets a prospective buyer, the question comes up, have you been pre-qualified or are you willing to be pre-qualified? So this video is going to be a very brief video basically describing what that's about and the importance of that. It's important because basically a pre-qualification gives the realtor and the buyer an idea of how much house they can afford, or at least how much house payment they can afford. There's no greater waste of time than to be looking at $850,000 houses and actually be qualified for a $600,000 house. Or maybe the buyer really can qualify for the $800,000 house but doesn't want to spend that high of a payment.
Right.
So this gives us a good idea of where to begin. James Carmody is actually a loan officer, but he's vice president with Synergy One Lending. Is that correct?
Yes.
Here in San Diego. And by the way, we are
Yep.
at Central San Diego. They cover conventional loans, FHA, VA, jumbo loans over $1 million.
Correct.
Right? And even, if I'm right, investment lending.
Yes, we do investment lending as well.
Okay, so I know that your company is able to put the buyer with the most favorable loan. In other words, it can actually be custom made for that buyer.
It's kind of like playing matchmaker with someone's finances and mortgage
All right, well,
to meet their needs.
all right, well, get ready to give us a little lesson. We want you to go briefly and walk us through an explanation of what the pre-qualification process is, what it entails, what you use to determine loanability, and I know you're going to cover income and job, a little bit about credit and reserves.
Yeah, Zig, I'm glad you asked. That's a great question that most realtors don't even actually take the time to understand themselves. So for you folks watching this video, please listen up. This is really important. This can save you a lot of heartache. The pre-qualification process for a mortgage nowadays, we're going to look at income, cash, meaning how much money do you have to put down. We're going to look at credit scores. How do you pay your bills? How do you pay other people? We're also going to look at reserves. Now, in that, there's specific income ratios, meaning how much money do you have coming in, how much money do you have going out, and there's certain programs that have hard and fast black and white rules as to what your debt versus income ratio needs to be. There's also credit score minimums. Now, we talked about FHA, VA, conventional, and jumbo. Those programs have different requirements. Some are extremely flexible and will go down to a 580 credit score. Right now, average credit is considered 680 and above. The new measurement for excellent is 760. So that's credit scores, where those need to be. Reserves. Some programs require you have a certain number of months of mortgage payments after your down payment and out-of-pocket expenses. There are other programs that do not, such as FHA and VA, don't require you to have reserves after closing.
Okay.
Yeah. So folks, it's very important that you go through the process to get pre-qualified to figure out exactly what you can and can't buy. Know your numbers, be confident in the numbers, so when you're out there working with Zig, you can write strong offers and you can make sure you're getting your offers accepted.
Would you answer me a question, though? I hear all the time as a realtor about front-end ratios and back-end ratios.
Yeah.
I know it's got to do with the relationship of how much you make a month to how much your mortgage payment is a month. Can you explain that a little bit better?
Yeah, great question. So front-end ratio versus back-end ratio simply means front-end, what's just the house versus my gross income. Before everything's taken out of my income, taxes, withholdings, all those things. What is that in relationship to the new housing payment, including monthly property taxes and insurance, versus the back-end ratio, which includes everything else. Maybe you have student loan payments, maybe you have a car payment or credit card payments. The back end covers everything else that would show up on a credit report. Front end's just housing.
So if I do a condo, which I sell a lot of those,
Yes.
it would be the principal, the interest on the payment, the taxes, the insurance, and the HOA fees.
Correct.
And so you would take
Yep.
that number, and that's got to be a certain percentage of how much
A
gross
certain
you make a
percentage
month.
of income, and that varies depending upon program.
About what is that?
Typically, we like to see people at no more than 38%. There are some programs that'll go up as high as 43, and some even higher, depending upon the rest of the person's profile and how
Okay,
strong
the
it is.
credit score and so forth.
Yeah.
Well, that's basically it. We're going to be shooting a couple of other videos on FICO scores specifically, and then also the process. In other words, once you're in escrow, what actually goes on with the lender. But until then, this is our introductory video. We're glad that you joined us today. And again, if you've got any questions, please call James at what number is?
858-525-3086.
It's Synergy One Lending. I'm Zig Hamner with Big Block Real Estate, 619-208-2121. Thanks for listening.
Thank